Canada's arrest of a Huawei executive on behalf of American authorities shocked global markets today. Hong Kong's main index fell 2.5%. In New York, the Dow was down as much as 700 points, but rallied back by closing. In Toronto, the TSX plunged 245 points. It's a volatile time for markets given the state of relations between the U.S. and China, two economic powerhouses. The collapse in oil prices is also creating some pessimism, especially in Canada. So for those who have money invested, how worried should we be? Greg Taylor is a portfolio manager with Purpose Investments, and he joins us from Toronto. Hi, Mr. Taylor. Nice to see you again.
Great, thank you.
So markets were down, especially earlier in the day. How much of that can be attributed to the arrest of Huawei's CFO?
Well, I think initially in the open, a lot of it was attributed to that. We came in Monday morning pretty excited that it looked like the G20 meetings went well, and it looked like we were getting close to a China-U.S. trade deal. And then we lost a lot of that momentum on Tuesday afternoon. And then coming in this morning, or going home Wednesday night, we thought today would be a pretty good day in the markets. But to wake up to that news, it really set everyone back and worried that the hope that we had on Monday with China-U.S. trade talks were breaking down.
And what happened throughout the rest of the day? Is it as grave, I guess, as it appeared in the morning?
Well, I think people are thinking sober second thoughts, thinking this may be not that big a deal. Maybe there is something more to that Huawei was going against the Iran sanctions. And if it's really that's a separate issue than the trade dispute between China and the U.S., and these are two parallel discussions.
How does the worry about the trade dispute and how it's all how it's all unfolded, how is that worry affecting markets right now, more generally speaking?
It's massive. The two big concerns in the market right now are the Fed hiking in the face of slowing global growth and trade. And they all kind of tie together because trade is global growth. And it looks like with Trump taking the hard line on trade sanctions against a lot of different countries, and when you get China versus the U.S., this is not good for anyone. It's inflationary, it's bad for growth, it causes a lot of tension and uncertainty, and stock markets hate uncertainty. So we need to get some of these issues resolved before we can go back to new highs.
It's kind of a political question, but are you surprised that the president hasn't recognized that? I mean, he's someone who talks about the markets quite often, watches the markets. Given the volatility the markets have shown, every time he says something about trade with China, are you surprised that that there still seems to be the same kind of rhetoric?
I am, and I think that's why I think you have some room for optimism here, that certainly we haven't had a president in a long time that's been so focused on the stock market levels. And certainly he knows that the Fed being aggressive and hiking was one arrow that was hurting the market, so he's come out very adamant against Powell, saying he wants him to back off and start to lower rates. The other one on trade is something that's completely in his control, so I would expect that if the markets got even more hurt, that he would definitely try and come up with some sort of deal with China to get the markets back to stabilize and go higher.
Based on what you've seen regarding the activity on the markets right now and over the past few weeks, how nervous do you think investors are?
Well, I think we're starting to see investors start to look at worry with their portfolios more than we have in a lot of years. Certainly since the global financial crisis, the markets have almost been managed by the central banks, trying to create a wealth effect by getting the markets higher and getting rid of the volatility out of the markets. The markets have really in the last few months have taken a step back from that as the U.S. Fed stepped back their quantitative easing programs and really left the markets onto their own devices. So as the markets have pulled back from that safety net of the central banks that are moving on their own accord, we're seeing volatility come back, which is really new to a lot of investors, as we haven't experienced this in a number of years.
So what's your advice to investors?
Well, I think you have to realize that volatility is normal. It's more abnormal than what we had a few years ago when the markets really didn't do anything but go kind of up in a 45-degree line all year. This is back to normal markets. There's cyclicals and secular moves. And I think really what you want to see is you want to go back to picking the winning companies, making sure you're monitoring your investments and not taking too much risk.
How do you know if it becomes abnormal? Like when you, like yourself and other people like you are saying, this kind of volatility is normal, it's cyclical, exactly what you just said, but how do investors figure out when maybe it's something more than just what's normal volatility looks like?
Well, I think the fear across capital markets is that these markets are getting really close to being run by computers and algorithm trading. And there's not as many people involved in them anymore. So even Tuesday afternoon was a great example where around 2 o'clock the markets just kind of hit an air pocket and the Dow dropped 700 points. And every trader I talked to in Toronto or New York was left scratching their head saying, what happened? And that's, I think, the risk and what's has come into the markets in the last few years, that there's so much algorithm computer trading that it's not really people making these decisions.
Is there an acknowledgement of that in the industry and any effort to change it?
I think there is a little bit. We're starting to hear more conversations about do we have more stops? Do we need to figure out what's going on with the program trading? But it's really going to come back to as individual investors start allocating more money to active approaches versus just buying the index.
All right, I'll leave it there. Thanks, Mr. Taylor. Appreciate your time.
You're welcome. Thank you.